and welcome to another edition of Trust Issues by Kepler Trust Intelligence. In this podcast, we speak to leading investment trust managers about the philosophy behind their strategies and the themes shaping their portfolios. In today's episode, we're joined by Marcel Stötzel, manager at the Fidelity European Trust. So Marcel, great to have you with us today.
Thanks, Joe. Great to be here. Thanks for having me.
Great. So I'd like to start off with the bigger picture before we dive into the portfolio. As we know, European equities had a strong 2025. They've continued to build on this in 2026. What do you see as the key drivers, and do you think this marks a turning point in their fortunes?
Yeah, so I think the most kind of important thing to highlight is that starting points really matter, and after 10, maybe even 20 years of underperformance versus the US, European stocks had really gotten quite cheap. And particularly when we looked even at kind of similar companies, if we look at, Siemens Energy versus GE Vernova, or, very similar companies, one listed in the US, one listed in Europe, the valuation discount between the two had reached kind of all-time highs around a year ago. And we talk about that being, a kind of, very fertile ground for mean reversion to that, and just needed a kind of small spark, to get some level of mean reversion in that trade. And turned out we had what we think are actually two quite big sparks, and the first one is Germany lifting the fiscal debt brake. So, Germany acting under self-imposed austerity ever since the Cold War, removing that handbrake and really kind of raising debt levels in the way that, most other developed countries had for quite some time. And then the second one was, raising defense spending quite materially across Europe. And that's obviously important for the continent to be able to defend itself, but also has, spillover benefits in terms of the employments that creates, the jobs. A number of autos factories, for example, can be repurposed for defense, etc. And I think just all in all, it just showed a kind of political willingness in Europe for the first time to actually fix their problems. And when you layer that on top of, as I said, very kind of low starting points for valuations, the environment was ripe for a very strong year, and it's continued into 2026.
Thank you for that. And do you see Europe more as a global or a regional play, would you say?
Yeah, it's a great question. I think the conventional view, for the last 20 years has been, don't touch Europe. European macro is a mess. And over that entire period, we've been reminding investors that actually 2/3 of continental Europe's revenues come from outside Europe, which I think is a stat that will surprise quite a lot of people. So actually only 1/3 of the revenues of the MSCI Europe comes from Europe. And, historically, our pitch has been, therefore, you don't need to be as concerned about European macro. You can still invest in, great companies like ASML or L'Oreal or, SAP or any of these companies that were major exporters without being too concerned about the macro, because it was only really impacting 1/3 of revenues.
And you mentioned valuation earlier. I think investors have often complained that European equities are perhaps cheap for a reason. Do you think anything has structurally changed, or is this still a valuation story really waiting for a major catalyst?
Yeah, so I think the main difference is, the willingness of politicians to fix kind of the continent's woes. And if I put some numbers behind it, Europe GDP per capita is roughly half of the US. And that's kind of, if you take a step back and think about it, is somewhat of a strange anomaly. I mean, America doesn't have, some space age technology that nobody else has. They're not a population of 300 million raw geniuses that are just intellecting their way through. It's really a function of the environment that they've created, a function of interconnectedness between the states, obviously, cutting red tape, being pro-growth, and also, on top of it all, funding and being willing to take on large levels of debt to kind of fund that growth. And all three of those are now kind of emerging in Europe, I would say. So if you see the Draghi report, it talks a lot about, competitiveness. It talks a lot about cross-border integration, essentially trying to make it as easy to do business in, Brussels and Berlin as it is in Austin and Atlanta kind of thing. And then lastly, we touched on it a little bit, but, the debt levels in Europe are rising, at the same time when maybe the US is getting, more cautious around their debt levels. So you bring it all together, and we think, that GDP gap, per capita, and basically the growth of the economy in the US with relative to Europe is going to close. We're not saying Europe is going to grow as fast as the US. We're not saying Europe is going to, be kind of, paradise and all the woes are going to be solved. But that gap relative to the US in terms of growth, if the politicians can do what they say they want to do and can do, by the way, what they've already done in terms of lifting the debt brakes and raising defense spending in the other three areas, we think that the GDP growth gap can close. And if the GDP gap can close, then, the valuation gap should therefore close too. And similar to GDP growth, it's not going to close entirely, but it's come back pretty much to all-time highs after the AI boom. So there's definitely room for valuations to converge.
And as you mentioned earlier, I think it's fair to say that one of the visible catalysts is fiscal policy. So with Germany's fiscal debt brake lifted and defence spending ramping up across Europe, as you've mentioned, how significant could this be for European corporate earnings, and over what time frame do you think?
Yeah, so it's a difficult one to kind of put numbers to. What I would say is the time frame is not going to be a 1 year kind of story. The wheels of motion still move quite slowly through Europe. Still a lot of bureaucracy that we need to go through and get all member states aligned. But on a 3 to 5 year view, I do think it can be a meaningful driver, and it will obviously differ massively by sector. So
Right.
some sectors, particularly if they're large exporters, will be largely unimpacted. But a sector like banks, for example, we think you could see, very good levels of growth. So to put some numbers to it, loan growth in banks has been pretty much flat over the last 10 years. And, if that's the core engine of earnings generation and that's flat, that's a tough time. We think, all of the things that are happening in Europe could push that to, 2-3% loan growth, through stimulating the economy, through needing to finance kind of all of these projects, whether it's infrastructure, whether it's defense, whether it's others, through kind of government reform, etc. And it might not sound like a lot, but I can tell you when you're valuing a company that has 0% growth or 3% growth, that makes an enormous difference.
Yeah, thanks. Some very interesting observations on the backdrop there. I'd like to turn to the investment process next. There's almost 9,000 listed companies in Europe. So how do you narrow down your universe to the most compelling opportunities?
Yeah, so I would say within that there are probably between 500 and 1,000 that
Right.
are kind of big enough for us to invest in. And if we then overlay our kind of process and our philosophy and what we look for, so typically we look for companies that consistently grow their dividends. And that's not just a backward-looking exercise, more importantly, that's a forward-looking exercise. So when we narrow down companies that we think have the even rough potential to grow their dividend, i.e., making profits, making cash, balance sheets not too stretched, you get to somewhere around, 300-400 that could potentially meet our criteria. And at that point, we lean very heavily on the Fidelity analysts. So, each Fidelity, we have 150 analysts around the world, probably one of, if not the biggest army of stock pickers. 30 of those are focused on Europe. And, each of them has around 20 to 30 stocks. And then we lean on them as to what their top picks within their individual coverages are. So if you think each of those 30 analysts will have, 4 to 5 top picks, that kind of narrows our universe down even more. And then from there, we can then pick and choose to get to that end portfolio of 40 to 50.
And once you've narrowed it down, as you've just mentioned, presumably some traits matter more than others. So what are the key criteria that you look for in potential investments, and how important is dividend growth in that?
Yeah, so it's really dividend growth is really the heart of what we try and do. And everything that we look at is in service of trying to find companies that can consistently grow their dividends. So most simplistically, if I take leverage as an example, if you're a highly levered company, ton of debt, chances that you can consistently grow your dividends are substantially reduced because you need to service, banks and bondholders and all of that first. But everything else, we look for structural growth, companies that can grow consistently. We look for kind of strong cash conversion, because at the end of the day, dividends are paid out of cash and not out of earnings. And we look for basically just businesses that we think are, strong over the long term, will be able to compound that dividend growth, will be able to hopefully grow the margin, will be able to, be somewhat, boring kind of steady Eddie type stocks, even though, certainly not all of the underlying themes are boring, but we want to see a kind of boring level of performance on the dividend growth.
And staying on the topic of discipline, you run a concentrated portfolio of around 40 to 50 stocks. So how does that level of conviction affect how you manage risk?
Yeah, so I would say that was probably one of my big learnings when I went from being an analyst to being a portfolio manager, and unfortunately, the first few years was, the paper portfolio, so I wasn't, risking any client
Okay,
funds.
right.
But the big learning that I had through that was, in my, youthful ignorance, I thought, this is easy. A 40 to 50 stock portfolio, you bring in your 40 to 50 best names and you rank them from 1 to 50. And, your first one is your highest conviction and your 50th one is your least lowest conviction. And the problem with that is it just gives you a massively unbalanced portfolio, So you might end up with 20 tech stocks, and then you've ended up with a fund that's above all else just a bet as to whether tech is going to outperform or not. So really, while we are quite concentrated in terms of the number of names, and we like that because it brings conviction and it brings kind of concentration in our top ideas, we're very much aware of kind of our sector exposure. And we keep our sector exposure plus or minus 5% to each of the big sectors. So,
Right.
Industrials, pharma, and, just that discipline of having something in each of those big sectors, gives the fund quite a nice balance. And more importantly, means that we don't get carried out on a stretcher. For example, when the Russian invasion happens, to have that discipline, to have energy, means we don't get carried out on a stretcher. When banks have their once per decade moment in the sun, having that exposure to that, and we like banks, so we may have had it anyway, but just as a kind of thought process, and similarly during COVID and other areas when the market gets super bifurcated, just making sure that you have a horse in the race in each kind of category. We really like to kind of give balance and make sure that the irony is actually through doing that, what ends up being the main driver is stock selection, which is actually what we think we're better at rather than, calling, is the market going to go up? Is it going to go down? Is value going to do better? Is growth going to do better? Any of those kind of questions.
And I'm interested in how that conviction plays out in your average holding period and also what typically triggers a sale from the portfolio.
Yeah, so our average holding period is typically around 3 to 5 years. And that's an average, obviously. There's some stocks that have been in the portfolio for 10, 15 years. There is one stock that's been in the portfolio for 30 years, ever since the days of Anthony Bolton. But that's obviously an outlier. I would say as a good average, 3 to 5 years is a good number to think of. And that's what we think of too when we enter into an idea. We're thinking about, is this idea going to outperform over the next 3 to 5 years? Not thinking, is it going to outperform over the next quarter? And also not being that far-sighted, think, is it going to outperform over the next decade kind of thing. And yeah, what triggers a sale is basically something called our 3 reasons sheet. And this is a legacy of Peter Lynch, legendary Fidelity fund manager in the US. And he had this very simple but very effective philosophy that if you can't list on an A4 piece of paper your 3 reasons why you own a stock, it's either too complicated or you don't understand it, neither of which should you be owning that stock. And the happy byproduct of that is it's there. And, obviously these days it's not on an A4 piece of paper anymore. It's in Excel, but the point remains it should be able to be printed out onto an A4. And what that means is that when one of those 3 reasons goes wrong, it's very objective. And we try to make the 3 reasons very objective. So it won't be, reason 1, this is a high quality company. That's not a good reason. It'll be like reason number 1, this is a great industry that's going to grow this to this range. Reason number 2, this company's going to gain this market share in this to this range. And reason number 3, valuation should be in this to this range as a result. So therefore, when one of those breaks, you can very clearly see that the thesis is broken. And at that point in time, you get out because it might still be a good stock. It might be a turnaround story, but it's a completely different thesis to what you invested in. And therefore, in our humble opinion, those are the most dangerous stocks to stay around in. When your thesis is broken and you stay in a stock because it's cheap or because it might get a turnaround or something of that nature.
And talking of stock selection, which parts of the portfolio are you most excited about right now? And where are you taking a deliberately contrarian view?
Yeah, so this might kind of somewhat surprise people that my answer is going to be 2 sides of the same coin, which
Okay.
I think is a little bit different to how some people think of it. But basically, what we're most excited about is our AI winners, and what we're most excited about is on the contrarian side, is our AI losers. And let me explain. So, firstly, we're very excited about the impact of AI. in terms of, the ability to change people's lives. We use it a lot in our investment process, and particularly, I would say, over the last 6 months, we've seen a step change in functionality in terms of what agents can do and the value that agents can bring. It's almost like having 6 different versions of yourself, and you sit at the top at the kind of orchestration layer, bringing it all together. And we look at everything else. We look at how the tech is progressing, how scaling laws are going, hyperscaler capex, what Amazon, Meta, Google, all of these guys are spending, what OpenAI and Anthropic are spending, fundraising, all of that all looks to be perfectly on track, and there are obviously risks, so it's not something we would bet 20% of the portfolio on. There are risks around kind of, are we overbuilding, etc. But for now, and certainly for the next 3 years, we see that building out quite nicely. So, and the conventional wisdom is Europe doesn't really have, players in this, but it does. And we think there are a number of names like ASML, like Schneider, like Legrand, Siemens Energy that are involved in either the chip making, the chips themselves, building the data centers, all of that play. That we think are going to benefit quite nicely. And actually, the valuations, by and large, are not that much different to long-term averages. So, contrary to some of the names in the US, where you're paying a big premium for the privilege to kind of have data center exposure, in Europe, it's much more, I won't say under the radar, but much less kind of appreciated, shall we say. So that's, the area I'd say we're most excited about. And you might say, well, you crazy man, then why are you also owning AI losers if you're such an AI evangelist? And I think, like with any theme, there's, like with any kind of, new emerging theme, there's kind of substance there, and we agree with the substance, but the market takes that substance and runs with it and extrapolates it far too far. And do I think there are going to be software companies that go to zero as a result? Of course. Just like any transition, any technological transition, there are going to be companies that fall to the wayside as a result. But the market has just sold off software indiscriminately, and if I take an example of a stock that we think, is pretty bulletproof versus, this AI threat, but has still sold off massively, is Amadeus. So Amadeus does travel software primarily, for airlines. So they will sell, software to BA or, any airline that helps the airline to kind of manage their ticketing process, their inventory, everything that goes into the backbones of running an airline. And to think that, someone like that is going to rip out the core engine of their business, give it to an AI startup or do it internally or anything of that nature, in an area that's as highly sensitive as travel and that's as core to their business as Amadeus software is, in my opinion, crazy. And yet, it's sold off as much as other companies that I would say are much more at risk of AI disruption. So we think that's an area where as stock pickers, we can really add value, is finding those perceived AI losers that are actually not so. And the happy byproduct is, to use the word again, it gives us balance, right? If we have an overweight in the winners and the losers, it means that, when NVIDIA has blowout results, we don't, get carried out on a stretcher, in either direction, or if they have blow up results, they don't get carried out on that. But then also over 3 to 5 years, we think both of those buckets can win. AI can be real, AI can deliver real benefits to society, to companies, etc. But it's not going to be a case of all AI losers are roadkill kind of thing.
That's, I think, a really interesting take on AI there. I'd like to move on to performance next. So the trust has comfortably outperformed the benchmark over the last 10 years. Performance has perhaps been more challenging recently. So could you talk us through the key reasons behind both of those?
Yeah, definitely. So, I think really the strong performance over the last 10 years has just really been a function of, sticking to a process that works, sticking to a philosophy that works, sticking to that dividend growth kind of mantra that, we've seen works through cycles, through different environments, through different markets, etc. And then layering on top of that, the Fidelity analyst team that can kind of give us the ammo that we need to execute on that strategy. Over the last year, definitely been much tougher. You put it very politely. It's been one of the toughest time periods, and actually, it reminds us a lot of what happened in the vaccine rally in October 2020, if you can remember. So basically the vaccines came out and everybody said, happy days, COVID is over, market rallied very strongly, and importantly, rallied in a very value-led way. So kind of all of the, airlines and kind of lower quality sectors, did very well because they came back, from the perception of being dead to, now the perception that everything was over and was done. And that's really, and we've been saying to clients for the last few years, that's really our kryptonite type environment. And we underperformed in that period, very similar levels of what we've underperformed now. And we talk about, stock picking being the main driver. And over 3 to 5 years, we still believe that it will be and has been. But over 3 to 5 quarters, when you're facing a very upward market, a very value-led market, that's typically the market that we struggle in the most. And, last year was one of the best value years ever, very euphoric market, very jubilant. And that's tough for us, as I said, to outperform over 3 to 5 quarters. But, if history is a guide, and history is obviously not always, but if it rhymes at least, 2022, 2023, 2024, when we came out of that, the end of that vaccine rally were some of our strongest years. And, we made those headwinds in 2020 and 2021 all back and more. And interestingly, the way that started was actually with a number of M&A bids. So we had in 2022 into 2023, arguably four companies acquired from our portfolio, all at big premiums. And that was basically, private equity and other companies looking at that and going, these companies are just way too cheap. These for what they can deliver on growth and quality, etc. These are way too cheap. And interestingly, now we've had already, over the last year to date, we've had one confirmed M&A bid and one kind of strongly rumored bid. So that's also interesting that, again, if history rhymes, that was how we kind of, the first indications that we were going to be improving performance in 2022. So hopefully that's a kind of harbinger of things to come in 2026.
And a quick question on some of the headwinds. We've seen a lot of turbulence around tariffs and oil prices in the last year to 18 months. How exposed is your portfolio to those, and how have you navigated these?
Yeah, so on a relative to the market basis, I would say it hasn't been the major kind of contributor to performance positively or negatively. If I think of the three main areas where tariffs are kind of impacted, it's mainly autos, given obviously, autos get largely exported to US, similar for beverages, and by beverages, I mean mainly alcoholic beverages, and then luxury goods. We don't own anything in the first two. We own a few names in the third bucket in luxury goods. So more or less, I would say we've broadly been in line with the market on tariffs. And that's what we like, because we have no idea what's going to happen next. And on oil, similarly, we don't really have an edge in what's going to happen in Iran or in any other kind of global conflict. So we run an energy position through a holding in Total that's more or less in line with the benchmark, and rather place our bets and fight fights where we think we have more of an edge.
And one final question, if we may.
Of course.
I'd like to close by looking ahead a little bit. What do you see as the key drivers of performance over the next year?
Yeah, so we touched a little bit on how value had done very well last year, and it's brought us to a situation very similar again to 2022, where the dividend yield of the fund of the trust, should I say, is exactly the same as the dividend yield of the market. And that's only happened twice in the last kind of 20 years or so that we've been running this trust. And that was in 2022 and now. And the reason why it hasn't happened before is over that time period, we've always, and that's still the case now, had substantially higher dividend growth than the market, had substantially higher returns, so higher quality than the market, and also, have been proven to be defensive. If you look at downturns, we've typically outperformed. So historically, Mr. Market has looked at us, our trust, and said, you get all three of those privileges, higher growth, higher returns, more defensiveness. We're going to charge you somewhere between 10 and 15% premium for the privilege of that. And we would then have been going to investors and saying, yes, you pay a premium for those attributes, but we think it's worth it. Now, in a way, and to be a little bit flippant, we say you can have your cake and eat it. In a way, if you have the same dividend yield as the market, but you're growing faster with higher returns and more defensiveness, the whole value versus growth kind of debate kind of somewhat falls away. So we think, that's firstly going to be a nice, at least end of the headwind that we faced, from value doing well, because, we pretty much have value characteristics now, at least relative to the market. And then what that means, therefore, is the main drivers, hopefully, in our mind, are going to be stock picking again, which, has been strong over 3, 5, 10 years. And if that's the case, hopefully it will continue to be strong over the coming year.
Great, I think that's a perfect note on which to finish. So Marcel, many thanks for your time today.
No worries. Thanks a lot for having me, Joe. I really enjoyed being here.
Fantastic. You can visit Fidelity European's website to find out more information about the trust. You'll also find our latest research note on the Kepler Trust Intelligence website, and we hope you join us again soon for another edition of Trust Issues. Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorised and regulated by the Financial Conduct Authority.